Welcome back to AlgoBot, your channel for clear, practical breakdowns of automated trading strategies for MetaTrader 5. I'm the AlgoBot team, and today we're exploring an expert advisor called Mass Index Reversal. This strategy is built around a classic volatility tool designed by Donald Dorsey, the Mass Index, which watches the market's high-to-low range expand and contract rather than following price direction. By the end of this video, you'll understand how the strategy spots a potential turning point, how it decides which way to trade, and how it manages risk with the average true range. Remember, this is educational content only. Let's get started. So what exactly does the Mass Index Reversal Expert Advisor do? At its heart, this strategy is a volatility-based reversal approach. It doesn't try to predict direction from price alone. Instead, it studies how energetic the market is by measuring the distance between each bar's high and its low, and watching how that range grows and shrinks over time. The tool that captures this is the Mass Index, a volatility indicator created by Donald Dorsey. The core idea is elegant. When a market has been trending, the range between highs and lows tends to widen as momentum builds. Dorsey observed that when this range expansion accelerates and then eases back, the market is often near a turning point. He called this pattern the reversal bulge. The Mass Index rises into a bulge, then falls back, and that fading of the bulge is the signal the strategy watches for. Because the Mass Index says nothing about direction, the expert advisor pairs it with a simple price moving average to read which way the market has been leaning. If price has been climbing into the bulge, the strategy treats that as an up move running out of steam and looks to trade against it. If price has been falling, it treats that as a down move losing energy and looks the other way. This approach is known as fading the prevailing move. This EA is designed to run on the MetaTrader 5 platform and can be applied to a range of instruments, from currency pairs to indices and metals, on whatever time frame you choose to study. It may appeal to traders who are curious about counter-trend and mean reversion concepts, and who prefer a rules-based, fully automated framework rather than discretionary decisions. As always, this is shared for educational purposes only, and trading always carries the risk of loss. Let's walk through the logic step by step. The expert advisor does all of its thinking once per completed bar, so it works from closed candles rather than reacting to every tick. On each new bar, it takes the most recently finished candle and measures its range, the high minus the low. That range is smoothed with an exponential moving average over the EMA range period, which defaults to 9. Then that smooth value is smoothed a second time to create a double exponential average. The strategy divides the single average by the double average to get a ratio that describes how quickly the range is currently widening. It stores these ratios and adds up the most recent 25 of them. That running sum is the Mass Index. Now comes the reversal bulge state machine. When the Mass Index climbs to or above the setup level of 27, the strategy arms itself. It's now watching for the bulge to fade. When the index then drops back below the trigger level of 26.5, the setup is complete and the strategy prepares to enter. Direction is decided separately. The EA keeps a price exponential moving average, the trend EMA, and compares its value now against its value 5 bars ago, the SlopeLookback. If that slope is positive, price has been rising, so the strategy reads an exhausted up move and signals a sell. If the slope is negative, price has been falling, so it reads an exhausted down move and signals a buy. Before any order is placed, 2 filters apply. The strategy allows only one open position per magic number at a time, and it checks that the current spread is within the maximum spread setting. If either check fails, it stands aside. Risk is handled entirely with the average true range. The EA computes a simple ATR over the last 14 bars. For a sell, the stop loss sits 2 ATRs above entry and the target 3 ATRs below. For a buy, the stop sits 2 ATRs below entry and the target 3 ATRs above. Because both distances scale with volatility, the strategy adapts its risk to current market conditions, and the stop loss and take profit manage the trade from there. Let's look at the actual MetaTrader 5 code driving this expert advisor. At the top of the screen are the input parameters. You can see the EMA range period set to 9, the sum period of 25 ratios, and the setup and trigger levels at 27 and 26.5. Below those are the trend EMA period and the slope lookback that decide direction, the ATR period of 14, and the two ATR multipliers, 2 for the stop and 3 for the target. The lot's input fixes the order size. In the middle, you can see the reversal bulge logic. The first line arms the setup whenever the mass index reaches the setup level. The next line checks whether the strategy is armed and the index has now dropped below the trigger level. If that combined condition is not met, the code simply returns and waits for the next bar. Once the setup completes, the strategy measures the slope by subtracting the oldest stored trend EMA value from the newest, and it reads the current ATR. Then the code branches. If the slope is positive, the market has been rising, so this block takes the bid price, places the stop 2 ATRs above and the target 3 ATRs below, and calls trade.sell. If the slope is negative, the market has been falling, so the other block takes the ask price, places the stop 2 ATRs below and the target 3 ATRs above, and calls trade.buy. Notice that both the stop and the target are set right there in the same call, so the position is protected the moment it opens. That's the entire decision, expressed in just a handful of lines. Let's bring this to life on the chart. On the price panel, you can see a series of candles with the trend EMA drawn through them. And below in the subpanel is the mass index with 2 dashed lines, the setup level at 27 and the trigger level at 26.5. The shaded band above 27 is the bulge zone. Watch how these two panels work together. We begin on the left with a run of falling candles. Each new candle closes lower than the last, and the trend EMA sloping downward through them confirms that sellers have been in control. As this down move stretches, look at the mass index in the panel below. It has been climbing, and now it pushes up into the bulge zone above 27. That tells us the high to low ranges have been expanding quickly, a sign the move may be reaching an extreme. The strategy is now armed and waiting. On the next candle, the mass index eases back and drops below the trigger level at 26.5. The bulge has faded. Because the trend EMA slope is negative, the strategy reads this as a down move running out of energy, and the buy entry marker appears. This is the fade. Rather than chasing price lower, the strategy positions for a bounce. The stop loss is placed a set distance below entry, 2 ATRs away, and the take profit target sits 3 ATRs above, giving 3 units of reward for every 2 units of risk. Now follow what happens next. The candles begin to turn. Price stops making new lows, forms a base, and then pushes upward candle after candle. The trend EMA flattens and begins to rise. Price works its way higher until it reaches the take profit target, and the long trade closes for a gain in this illustration. Notice the strategy never tried to predict the exact low. It waited for the volatility bulge to fade and let the reversal come to it. Now the market keeps rising, and this is where the second setup builds. The candles continue climbing, printing higher highs, and the trend EMA is now sloping firmly upward. Down in the subpanel, the mass index climbs again, and once more it pushes into the bulge zone above 27. This time it is an up move showing signs of exhaustion. The strategy arms itself for the opposite trade. On the following candle, the mass index falls back below the trigger level at 26.5. The bulge fades a second time. Now the trend EMA slope is positive, so the strategy reads an exhausted up move and the sell entry marker appears. The logic is a mirror image of the long. The stop loss is placed 2 ATRs above the entry, and the take profit target sits 3 ATRs below, keeping that same 3-2 reward to risk shape. From there, price rolls over. The candles begin closing lower, the trend EMA turns down, and the market slides toward the take profit target below. When price reaches it, the short trade closes for a gain in this example. Once again, the strategy faded the crowd. Entering as the prevailing move lost momentum rather than following it. Step back, and you can see the rhythm of the whole approach. The mass index times the moment, rising into a bulge and then fading back below the trigger. The trend EMA slope decides the direction, always against the tired move. And the ATR sets the distance for both the stop and the target, so risk scales with volatility. Of course, not every signal behaves this cleanly. Real markets produce false signals and losing trades, which is exactly why the fixed stop loss on every position matters so much. That brings us to the end of our look at the Mass Index Reversal Expert Advisor. We covered how Donald Dorsey's Mass Index measures the expansion and contraction of the market's range, how the reversal bulge arms and then completes a signal, how the trend EMA decides direction by fading the prevailing move, and how ATR-based stops and targets manage every trade. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses are a normal part of it. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe so you don't miss what's coming. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.